Hey everybody, welcome back to another video. Today's topic is on what's going to drive demand for Bitcoin long term. In prior videos, we explained how Bitcoin isn't just a speculative asset, but that it's a tool to resist inflation and censorship. In other words, the state's monetary monopoly. Then we discussed how it works and the economic limits of a single chain, which inevitably results in substitution. And that's really been happening as demand exceeded capacity of the first chain, but it's been going unnoticed. Then we identified why that chain is LTC. And in the most recent video, we discussed the speculative opportunity around buying that second Bitcoin chain and attempted to model what a repricing might look like. But this video is going to zoom out a bit and answer the question of what will drive increased demand for permissionless money. So in other words, what's going to catalyze demand for censorship-resistant money and transition us out of this popularity-driven casino market where it's all ideological and speculative and more into the real monetary adoption phase. In order to do that, we need to understand the macroeconomic context, the larger picture of where the world is at and where it's headed. It's essential to grasp Bitcoin's long-term relevance. The fundamental truth is that most people still haven't recognized how high the cost of state money is and will become. Most have effectively avoided the high cost through buying financial assets, and they've really fully bought into this illusion of endless financial asset price appreciation. I mean, on paper, almost everyone who owns financial assets feels fine, or some even feel wealthy. Right? Maybe some feel the symptoms of higher consumer price inflation, declining real wages, rising inequality, but I don't think most have really grasped what's actually happening. And that's what this video is about. It's about how the illusion of endless prosperity built on cheap credit, which led to historical debt levels, enormous asset bubbles, eventually and ultimately leads to very high degrees of money printing on scales that will dwarf prior rounds of stimulus, which will end a long-term credit cycle we've been in for 40 plus years. It's really about how, why, and when people will realize what looked like wealth and prosperity was actually just numbers on a screen, propped up by policy and not productivity. So as this realization plays out, the entire foundation will start to shift. It'll be slow at first and then suddenly. The public eventually is not going to ask when moon. They'll ask what's actually real. So this video will walk you through that unraveling. We'll try to do it step by step and show how throughout history every faltering monetary system has followed a similar path. You know, history rhymes, but it doesn't always repeat because there are new variables. The situations aren't identical, but the phases in which this follow will rhyme what's happened in the past. This time it's more global, it's on a much larger scale, and there is a more effective, lower cost alternative that may give individuals a chance at exit, where in previous times alternatives had failed. Right? Gold had failed within 100 years ago, but we'll show you why Bitcoin can potentially succeed where gold failed. And before we get into it, I know a lot of people have been talking about this for a long time, over a decade, and most have dismissed these people warning about these things as crazy conspiracy theories. And I think it's really because it hasn't happened yet, right? It's taken so long because the scale of this is so large that most people have written off a lot of these Austrian economists. But I'm going to attempt to show you how they're actually right, just wrong on timing, and that this is the inevitable path that's going to transpire. So first, let's look at the phases in which this process typically happens and then apply them to the most well-known historical example, and then also apply the same framework to where we're at currently. So phase one, and that's the phase we're currently in, is avoid inflation through investing or speculation. This is where people feel that they can avoid inflation through investing and speculating on financial assets, most of the excess money being created is going into um, financial assets, which builds momentum. And then because it happens over a long period of time, most people fall into this false belief that the only way to get rich is through investing and that it'll continue forever. Eventually, we move into phase two, which is panic and preservation. The transition often begins with a macroeconomic shock. It's usually some combination of unpayable sovereign debt, rising rates as bond market holders lose confidence in the central bank's ability to control inflation, a realization that the underlying economy isn't responding to stimulus, so you get persistent stagflation, which results in collapsing real wages that exposes the structural fragility of the monetary system. As central banks lose control over inflation expectation, a crisis of confidence emerges in fiat denominated stores of value, so bonds and other forms of financial assets. That leads us to phase three, which is monetary expansion. As a result of interest rates beginning to rise, the central bank and government are forced to monetize debt because there's no other way to raise tax revenue to support the bloated government spending. This, in current times, will happen stealthily. I mean, central banks and governments don't want to admit that they're actually printing money, so they come up with these loan facilities and they call them short-term programs. We've already seen the emergence of one in March of 2023 with the BTFP program, but really they're going to try to hide the money printing and keep confidence from the public in themselves that they can control and manage the economy without creating inflation. So phase four is erosion of confidence completely. Financial assets that are dependent upon artificially cheap credit fail, at least in real terms. Real interest rates begin a long-term trend higher, and capital starts to rotate from financial assets into real stuff that best protect individuals from this situation. And then the final phase, phase five, is exit and migration. You get rejection of state money, and the public starts to use alternatives. So as defensive measures prove insufficient inside compliant systems, capital and talent begins to migrate. In the current times, this will be both physically and digitally, because we do have tools now that are developed. They're underdeveloped, but you should see as demand increases, these tools begin to become more mainstream. There will be more capital that funds these types of projects. So wealth no longer just flees jurisdictions, it flees traditional institutions. Users will abandon compliance-first platforms for permissionless protocols, and then builders will begin operating from pseudonymous identities, choosing digital jurisdictions like DAOs, private networks, and self-sovereign marketplaces over geographical bound citizenship. We'll get into how I think that'll play out in another video. For now, we'll just focus on the short term of what happens. So let's apply this to a historical example. This is Germany, or the Weimar hyperinflation example. So phase one is where inflation is concealed in financial assets. Really, you can see here from the chart, this is nominal asset prices in Germany, 1900 to 1930, that when the war started in 1914, things seemed fine on paper. Financial assets rose for a long period of time, really through the mid-1918. And so the government was able to paper over all of this war spending. Even after losing the war, asset prices didn't immediately go down. The public probably thought at the time that they could continue to protect themselves against inflation by buying financial assets. Phase two is panic and preservation. So as the money printing really started and the public was aware of it, you saw this rotation out of stocks into real estate. Real estate usually is a better hedge against inflation, at least in the short term. So that's what you saw during this panic and preservation phase. And then we can move to phase three. This is monetary expansion. So as the government started printing money and the public realized that this was indefinite, that it wasn't going to stop, you saw erosion of confidence. Real asset prices in real terms are shown on this chart here. Real interest rates rose. Central banks stepped in immediately in 1918 to suppress rates. And then as inflation persisted, really you saw this erosion of public confidence in the mark, uh, and the erosion of the real value of financial assets. Phase 4 and 5 of erosion of confidence and exit migration is kind of depicted here. And what I wanted to show was the value of the real stock index against the rising consumer prices. This is what I think inevitably will happen on a much more broader scale around the world, and that's where you start to see, once public confidence is eroded in the central banks and government's ability to control inflation, you see a rotation out of financial assets into real goods. People start hoarding things because they think they're going to be more expensive in 6-12 months. Hoarding, regular stuff that they're going to consume. That's what causes this rotation out of financial assets into real goods and services. Let's summarize what we just went through. So at first, you see inflation contained to financial assets. Almost all the inflation is going into financial assets as people feel that they want to increase their wealth, and that's the best way to do it. Eventually, the stimulus stops having the same effect, right? Each dollar spent gets lower real economic output, and just no matter how much stimulus you provide, economic stagnation results. This eventually leads to a loss of confidence in central banks and government's ability to control inflation. And when that confidence starts to erode, bond market holders demand compensation for that inflation risk. And so you start to see interest rates rise as they sell bonds. Financial assets dependent upon low interest rates begin to fall. And then because the economy is so dependent upon this wealth effect, is so dependent upon ever-increasing financial asset prices to drive consumer spending, eventually you get monetary expansion. It's the only tool that central banks have, right? So they pretend like they have all these tools, but really the only thing they can do is print money. That inevitably leads to the public seeking alternatives and rejecting the high-cost state money. So hopefully that makes sense, and it can help you develop this mental framework and apply it to where we're at today. And that's what we're going to attempt to do right now. So the question of where are we at now, I think it's following the crack-up boom framework that Mises presented long ago. So we'll go over the historical evidence that we haven't had recovery really since we started quantitative easing and money printing. We've just had papering over the problems, and the amount of paper covering up of problems has only magnified over time. It's gotten more extreme, and we've had to do it sooner and sooner each time, right? The amount of quantitative easing is speeding up both in time and total volume. We'll look at some political and cultural evidence of that depicts that we're at the end stage of a credit cycle, geopolitical evidence as well, explain why stimulus stops working, and what's next, like in the immediate to midterm. So for historical context, this quantitative easing in money printing really began in 2008-2009 after the global financial crisis, which was started by this real estate bubble. I remember Ben Bernanke and Alan Greenspan, who's the prior Fed chair to the global financial crisis, both making public comments about how quantitative easing was just a one-and-done type ordeal, that it was a temporary solution, and that the U.S. wouldn't ever become a banana republic. Right? That was my journey into realizing that this was never going to end. That really happened for me in college. But moving on from there, in 2011, we had the European debt crisis, which resulted in more QE dollar swap lines to prevent a euro collapse. 2015-16, we had China devaluation, repo market seizures. And I remember in 2018, we had the Fed reverse these tightening plans that they had, which pretty soon after in 2020 we had COVID, which resulted in the highest amount of money printing we've seen really in history, direct fiscal transfers and negative real rates. And since then, we've had consistent problems. Right? In 2022, 2023, we had inflation, at least measured by CPI, go dramatically higher than what the central banks were saying to us during COVID, that this inflation was transitory, right? And then that catalyzed the fastest rate hike cycle in history, followed by another banking crisis. And this was immediately responded to, right, in March of 2023 with the BTFP program. It was pitched as the short-term loan facility, but these banks that were getting loans were giving the loans directly to depositors, so there's no way for them to ever pay those loans back. These types of policy responses will be forced inevitably at a greater scale here in the future. And right now, the last few years, we're kind of in policy paralysis and political instability. And what's really telling to me is markets are hanging on every Fed word. We've never had more people looking at each FOMC meeting and trading around it than we do today. It's like every single word that Jerome Powell speaks, the markets respond to. Let's look at some evidence from the social and political perspective. I think it's easy for most people to realize this if they look around, right? These economic distortions have produced deep political fractures. We see the widest divide in the United States that we've ever seen, right? We see rising populism, not just in the US, but around a lot of the Western world. Contested elections and mass protests in major democracies. And then this cultural decline as well. So the culture of growth, discipline, savings, and family formation has eroded, and it's been replaced by mass dependency on the state, speculative finance. So I see so many influencers on Instagram and TikTok that are talking about themselves being experts in investing when they don't understand that what's driving financial assets and what has driven financial assets is just inflation. Everyone thinks in order to get rich, you need to buy financial assets. That to me is a sign that we're close to the end. I don't think we're quite there yet. But this culture is evidenced all over the place, right? We're not rewarding productive behavior. We're like some of the highest paid people in the world now are sex workers online through OnlyFans. Not to say that that's bad or I have anything disagree with it, but the culture definitely has shifted quite a bit, and the structure of society is no longer rewarding productive behavior that create wealth long term. Now let's move into geopolitical evidence. So recently with the tariff wars, China, which was once willing to accommodate U.S. interests for access to the capital markets, is sort of rejecting the American financial model. It's not conceding as the U.S. expected during tariff wars, and I think it realizes, and this may make people upset because of political bias, but the U.S. isn't in as strong a position as it once was globally, and I think the rest of the world recognizes that, right? An economy like the U.S. that's so dependent upon importing cheap stuff from the rest of the world has limited negotiating power, right? If the entire U.S. economy is dependent upon the goods that your country produces, why would you let that country bully you around? And it's really not that they have better alternatives. The rest of the world followed the U.S. ever since 2008, or the vast majority of the world followed the U.S. down this same path of artificially manipulating rates lower, devaluing their currencies, and creating asset bubbles. So it's not like there's a good solution out there, and that's why I think that the most likely path for individuals around the world are not going to go to trust another nation state, but move into these decentralized, permissionless money protocols that can protect them from their own governments. That's where I see capital, talent, and our economy moving, especially as this information economy becomes more dominant, right? The trade of information natively, which these decentralized monetary protocols can protect, because they don't, those assets don't exist in the real world, will be much cheaper secured by digital networks than by high-cost nation states. So we'll look into some further evidence and what really catalyzes change. So when stimulus stops working, I can explain that a little bit. In earlier decades, stimulus did have real effects, right? Government stimulus did lead to real increases in economic output. But we're seeing now and witnessing over the consistent step in from governments and central banks that we're not getting the same level of economic output that we used to. So soon lower rates will do almost nothing. The private sector is already extremely over-leveraged, that eventually printing more money will no longer lift asset prices. And when that happens, you'll see a reverse in the wealth effect. You'll have a negative wealth effect. For an economy that's so dependent upon ever-increasing asset prices to give people the illusion that they're wealthy so that they'll go out and spend money, when that ends, you should see stagnation, business failures, and a real recession, which leads to stagflation. So you see rising consumer prices and kind of all the things we just discussed earlier. So this system that can no longer grow through credit expansion only prolongs and makes a eventual collapse worse. And I don't think this is going to absolutely collapse. It will be a longer process, not like Weimar Germany. But it should play out on the same type of structure. And the last point I wanted to make, in further evidence of this being close to the end, is that everyone now tracks global money supply. I mean, I see this everywhere on social media, on X. Everyone's looking at money supply, where this monetary expansion and resulting financial asset price increases, like the correlation between the two, has persisted and existed for a long time, really since after 2008. But it's only now that everyone realizes that, and usually when everyone realizes the strength of a signal, it's close to ending. I don't think it's going to fail right now, but it does make me think that this signal will eventually no longer work. And because we have the framework for understanding how these processes usually take place, we can know with pretty high confidence that eventually that signal won't work. This is just further evidence that we're getting close to the end. So let's move on to what's next. Let's look at exactly what's happening right now in the current state of things. And my conclusion really is that there's a high probability of a blow-off top. Usually credit cycles end with this parabolic move higher. So let's dive into some of those metrics. As I pointed out in previous videos, sentiment has always been super important to me. It reflects net positioning, right? If people are bearish, that means they've sold generally. And the path of least resistance is opposite to the majority most of the time, right? If everyone's sold out, extreme pessimism, the result usually is bullish. So over the past few months, we've seen some of the most extreme and persistent negative sentiment readings really around tariff news. And this was actually higher and longer in bearish sentiment than 2008. And so at the time, it seemed likely to me that we would get a reversal here. It took a long time, and pessimism persisted for quite a while, but now we've seen a pretty crazy V-shaped rally and likely head to new all-time highs in the coming months. This next chart shows global money supply. I know I said that this eventually probably won't work, but I think in the short term, at least the expectation that it's going to work is going to lead to enough momentum because people are positioning ahead of expectations of global money supply. And once prices break key levels, that momentum starts to accelerate. And I think we're going to see relative attention on the crypto space over stocks, like we have seen in 2017 and 2021 for a bit. We still haven't seen that since the bear market lows in 2022, 2023. But I do think we're going to see relative attention shift to cryptocurrency, especially because we have this overarching macro narrative that Ray Dalio and famous investors are talking about to people about a changing monetary order. So Bitcoin can succeed on that narrative and really start to dominate financial discussions, right? We saw stocks like Nvidia and other tech stocks kind of dominate and take the mind share over cryptocurrencies. But I think we're entering a macroeconomic environment in which Bitcoin can really outperform. And because crypto is so small on a relative basis to a lot of these other asset classes, we can see a real crazy run. So the next chart here is money market and cash hoard. We have record amounts of dollars in money market accounts, and these accounts are vulnerable to FOMO, right? This is cash on the sidelines, really, that can start to reposition as sentiment improves, as news headlines start to become more bullish. That's a lot of capital that can enter into a very small market like the cryptocurrency market. The next chart is global liquidity. Really, this is a function of dollar and oil prices, right? When the dollar is lower on a relative basis against other currencies, that frees up global liquidity, or it improves global liquidity conditions, as well as the price of oil, right? The price of oil is a core component in almost every consumer good that we purchase. The less people are spending on oil and gas, the more money they have for other things, like financial assets. And then another last point I wanted to make was that this tariff-driven news led to, it pulled forward a lot of demand because large companies wanted to avoid these higher taxes. So they overordered in preparation, which temporarily drove inflation higher than it normally would have been. But over the next few quarters, it's likely to result in official CPI prints that are down, which people respond to headline news. Markets do trade on those a bit, and that can catalyze a breakout, or at least provides further evidence and makes the probability of a breakout to the upside higher. This next chart, again, is from Tony the Bull CMT. It's a Bitcoin dominance chart. And what's been unique this cycle, and a few important points that I want to make, is that, one, Bitcoin's not rising on fundamental strength. It's trading at its highest speculative premium ever. So it's just trading on a positive story and the fact that institutions and large capital are now comfortable with buying it. But that reality, as we pointed out in the previous video, is false, and we have a catalyst that will shift the narrative that's likely to play out. But once dominance starts to roll over enough, right, once capital starts to flood altcoins from Bitcoin, that momentum will take over, and that's generally when the mass psyche or mass public focuses on crypto, and they're not going to be buying Bitcoin. Likely. Maybe some, but it takes far less money to move altcoins than Bitcoin, and if the narrative changes like I think it will, like we discussed in the previous video, then the altcoin that I think is going to do the best will see a lot of attention. And then the last chart on here is from Raoul Pal's company, Real Vision. It shows historical Bitcoin cycles. Not to say that it's going to always play out the same, but this type of chart pattern structure where you have the two consecutive higher highs and higher lows usually precedes this major expansion. And I do think that sentiment and price will increase dramatically just because we haven't seen it yet. And I think because we're at the end stage of a credit cycle with this macro context, that the blow off can be very extreme. And again, because cryptocurrency is so small on a relative basis and it's so globally accessible, right? It's a global market that any retail person can participate in. It really has potential to do really well, all things considered, given the likely fear type narratives of a global monetary system change affecting the mass psyche. So let's recap this video. We explored the phases a monetary system goes through before it ends, and why I believe we're now entering the final chapter of at least that phase one cycle, what Austrian economists call the crack-up boom. We walked through how inflation is initially hidden in financial assets, so stocks, bonds, and crypto, and how that gives the illusion of prosperity while underlying fundamentals quietly deteriorate. This stage can last and is lasting longer than most people expect. But it makes sense because when a country like the US holds reserve currency status, it allows it to kick the can further than historical examples like the one we discussed, like Weimar or Zimbabwe. But eventually the illusion must break. As trust in the dollar really erodes and the cost of state money becomes impossible to ignore, capital will begin to rotate out of these inflated paper assets and into real goods. So fuel, food, land, labor, and most likely non-confiscatable censorship-resistant monetary systems. That's where Bitcoin chains really come in, not as speculation, but as a response to broken trust. They won't rise just because of hype like they are now, but because they offer a real economic alternative that's lower than the cost, that lowers the cost really of resistance when traditional currencies fail. We also talked about where we're at right now in the process. So this volatility, the sentiment, the flood of capital into money market accounts, and the expectation of upside. So it all, to me, points towards acceleration. So it's not the end of the bull run. It probably is the beginning of the final blow-off top that will mark the transition out of this monetary illusion. But that revelation and that revolution won't go uncontested. So almost everyone assumes the wrong path this will go through next. That's really where my view diverges from the consensus. So in the next video, I want to explore what that inevitable conflict between people who use Bitcoin and the state looks like. So when a permissionless, decentralized money starts to compete seriously with the dollar, we'll walk through the stages of government response, from media smears to regulation, potential banning, censorship, and then mining attacks. And we'll talk about how the market actually can resist. Because if this ecosystem truly becomes a threat, it won't be treated like a game or a toy anymore. It'll be treated more like a war. And it's better to understand the truth and how Bitcoin actually can protect itself before it starts, or else it'll fail. So stay tuned for that. Thanks for watching the video, guys. Make sure to like and subscribe to the channel at the Litecoin Forecast. You can follow me at WLitecoin on X, and then my book that goes into way greater detail than these videos and is more professional will be released. It's titled Why Everyone's Wrong About Bitcoin. That'll come out hopefully within a few months. Thanks again, and see you in the next video.